Good afternoon, and welcome to Brookfield's 2023 Listed Affiliates Investor Day. My name is Alan Fleming. I head Investor Relations for Brookfield Business Partners, and on behalf of the entire senior management at Brookfield, we're really pleased to have you here today. We have a full agenda planned for you this afternoon. We'll get started with a panel moderated by Brookfield CEO Bruce Flatt. Bruce will be joined by Cyrus Madon, CEO of Brookfield Business Partners, and Jared Parker, co-head of North America for Oaktree's Opportunity Strategy. They'll have a discussion on the current value investing environment. After that, we'll have updates from Brookfield Business Partners, followed by Brookfield Infrastructure Partners. We'll then move into our second panel, focused on opportunities emerging from digitalization and decarbonization and how our businesses are positioned to benefit. We'll finish the afternoon with an update from Brookfield Renewable Partners, and then we invite all of our shareholders and investors here with us today for a reception with senior management. A couple housekeeping items to note. We have two short breaks planned during the course of the afternoon, one after BBU's presentation and the second after BIP's presentation before our second panel. We'll also leave time for questions at the end of each presentation. For those in the room, we just ask that you raise your hand and wait for the mic that's floating around. And for those online, please submit your questions at the bottom, at the text box at the bottom of your screen. Before getting started, we'd like to remind you that in responding to questions and in talking about new initiatives and our financial and operating performance for the Brookfield companies presenting today, we may make forward-looking statements, including forward-looking statements within the meaning of Canadian and U.S. security law. These statements reflect predictions of future events and trends and do not relate to historic events. They're subject to known and unknown risks, and future events may differ materially from such statements. For further information on these risks and their potential impacts on our companies, please see the Risk Factors section of the annual report for each of our companies, which are available on their respective websites. And with that, I'll turn it over.
Okay, welcome everyone. Thank you for being here. I'm going to moderate this panel. I think what that means is that somebody thinks I'm moving into the chairman's role soon, as opposed to normally when you're a CEO you get to do a speech and I get to do a moderation. So this is very interesting. Maybe a message there. We're thrilled to be here. Cyrus on the far side and Jared beside me. Look, I think. I'd maybe just frame the panel by saying that the macro world is always very volatile. It seems more volatile lately. But I think I hope what you'll hear today from these two individuals is that there's always opportunities, and actually even more when you're in these type of environments. Our overall view on rates and the world out there is that rates generally have peaked around the world. They may stay a little higher for longer, but what's going to happen is that capital is going to come back into the markets because there's just certainty which is in the markets now. When you have extreme uncertainty, inflation is going to be 12%, interest rates are going to go to 10, whatever that is. When you have extreme uncertainty, you really just don't know where to price, and therefore no transactions happen. And with that, Cyrus, I just that initial comment, I just say, how has that affected? I guess just generally, how has that affected the private equity business? And deals and what people are doing out there, us and just broadly the general industry?
Yeah, so I think there's two different points here. One is the, I'll say, industry fundraising has, industry-wide for private equity, has become much tougher because many firms were relying on selling their assets into a higher multiple environment, and they did it for a long time. In fact, I think since the credit crisis, really, rates have been coming down and multiples have been increasing, and there's been lots of liquidity to sell into. So in fact, probably most firms earned most of their profit by selling at higher multiples. That has changed very rapidly, and it's put really a deep freeze on transactions in a sense, and that has created a problem for many institutional investors, not all of them, certainly many of the North American ones, where they are now over-allocated, that's the term they use, to private equity. They have more than the target they wanted in private equity, exacerbated by the fact that public market valuations dropped. So they aren't re-upping, they aren't making new fund commitments to most GPs out there. So, you know, there's definitely a slowdown in fundraising environment for most firms, but clearly there's been a bifurcation. There's a bifurcation going on of sponsors, those who continue to have access to capital, relationships, et cetera, and those that don't.
But Cy, the equity markets have come up a lot in the last like 6 months. Is that a story that was last year's story and we're now into the next chapter?
I think things are definitely getting better and definitely stabilizing, and we're starting to see deal activity, but it's not back to the point where limited partners are ready to write large checks to PE firms across the board. So I think there are going to end up being fewer private equity firms when this is all done with.
And what about deals?
So on deals, deals are happening for those that have access to capital. And if you have access to capital with limited partners and investors and the financing market, and that's the critical thing that investors need access to in order to get transactions done, you can get things done. So it was very slow and starting to pick up. But even all the lenders and the lending community is being far more selective than they have been the last 10 years.
And have you, in the companies we have in the portfolio, forget about new deals, what about financing those? Because 12 months ago, the markets were pretty closed.
Pretty dire, yeah. It's actually a similar story to the PE firms. There are haves and there are have-nots. Great companies have access to capital. Strong sponsors who have proven ability to deal with issues and be responsible borrowers continue to have access to capital. And I'm sorry, Jaspreet, I'm going to steal a bit of your thunder here, but in the last 3-4 months, we refinanced $11 billion of borrowings at our portfolio companies. $11 billion. I think we may have been the most active issuer in North America at virtually the same cost. Virtually same cost. Our cost barely went up.
But base rates are up by 400 basis points. How is that possible?
Well, base rates are up a lot. 10-year rates are not up that much. Like the 20-year, if you go back 20 years, the average 10-year treasury is about 3%. And today it's 4.5. Like,
and the spread has come
in, and if you own a great company, the spread keeps getting tighter because the company generates more and more EBITDA every year, and you're actually paying your debt down.
Which actually, Jared co-runs the big opportunities fund at Oaktree. I would use that to segue into these businesses out there that are good are getting better, but there must be a lot of, I think there was I saw an email this morning out of Oaktree that said finding good companies with bad balance sheets. And I guess that really is what you're trying to do, is find the ones that Cyrus doesn't own.
That's right. Not everyone's as fortunate as Cyrus, I don't think. Although there are, to your point, and that's been our mantra since Bruce and Howard started the firm, 30 plus years ago, has been looking for good, high quality businesses that for one reason or another have a balance sheet that doesn't match the moment for that business. And I think there's always that opportunity. That opportunity set is much bigger today than it has been for probably since the GFC, maybe the last 15 years.
Because the companies are better, or they were ill-financed, or they just got unlucky, or what's the prototype you're looking for?
Let me give you the archetypal issuer that fits this billing. We're seeing this across all industries. It's a bit unique, in fact, because most times when we've seen a dislocation in credit, there's been a single industry at the epicenter that's feeling the adversity most acutely, right? It's been
oil and gas, or airlines, or something.
So during the pandemic, travel and leisure and energy, right, for sure. Those were the industries that were most adversely harmed. In the financial crisis, it was the banks and the financial institutions. In the tech bubble, it was the tech and telecom center. Right now, it's industry agnostic. And what's happened is, Cyrus referenced 20-year average rates of 3%. Well, a lot of transactions took place in 2020 and 2021, meaning new debt was issued not at the long-term averages, but at the nadir, when base rates were at 0% and treasuries were at between 0 and 1%. And those businesses, which may be very good businesses, took on capital that made sense in that environment with low base rates, low spreads, and now we're coming up on the sort of 5-year anniversary of the first wave of that. That debt's all coming due. And it's coming due into an environment with more normalized interest rates and more normalized spreads.
And in the fund, are you buying bonds, or you're doing rescue finances? Like who is getting harmed, or who are you helping?
Who are we helping?
In the process of that?
So our platform has the benefit, much like yours, of very broad mandate and broad flexibility. So we are helping companies that have near-term maturities that need to be contended with that can't get priced in the broadly syndicated market. So unlike the sort of the issuer that Cyrus is describing, a number of issuers, particularly if you're single B or B minus or triple C, you don't have access to broadly syndicated capital, period, full stop. Today, there hasn't been a new triple C deal launched in over a year. And the rate at which the triple C index is trading would suggest your cost of borrowing is going to go up twofold from the on-the-run coupon that you're paying for that debt right now. So
if it was issued in that window.
In that window, which a lot of it was. I think something like 80%, you would know the stats better than me, something like 80% of sponsor-to-sponsor transactions took place in that 2020, 2021 window. So there's quite a bit of that out there right now. And so that issuer, whether it's sponsor or public, has to start thinking about its 25 maturities now, 12 to 18 months ahead of time. And some of them will wait, and they'll hope that either interest rates will fall or their earnings will accelerate and they'll grow into their balance sheet, or both. Some of them are coming to us and saying, hey, we don't want to wait. We value the certainty of pushing out this maturity wall right now, and can you help us? And that's that's perfect.
And those would go in your opportunities fund versus, and maybe just for the benefit of people here, we also have, which may not be specifically what you're doing day to day, but a private credit business which has been growing fast. And how do those work together? Or are they side by side or different?
They're side by side. So we've got multiple strategies. Oaktree is really a credit-oriented asset manager, and we've got lots of different products. Where I sit in the opportunity strategy is our broadest and most flexible product. We have a sister product, which we call Oaktree Lending Partners, which focuses on helping sponsors make acquisitions, and specifically helping large-scale, what we would consider to be blue-chip sponsors, access capital to invest in new companies. That market is really competing with what used to be a market that was owned by the banks, and the banks have been retreating. The size of the direct lending market is now equivalent to the size of the broadly syndicated loan market, about $1.5 trillion each. And Oaktree has actually really been hesitant to enter that market until now. And right now we see that market as having very significant advantages for managers like ourselves because, unlike was the case in 2000 or 2021, you're able to invest into that market. We're able to invest into that market with not only high quality sponsors, but much lower loan to values. Call it if that archetypal issuer in 2021 was getting 40 to 60% LTV on the deals they were doing, it's probably 25 to 40% today much tighter documents with real covenants, maintenance covenants, real collateral pledges, and lower EBITDA multiples, and the same or even wider spreads, plus a much higher base rate.
And are the opportunities global, everywhere, U.S., somewhere, Europe? Like where is the,
Sure.
on the liquid side?
Yeah, on the liquid side, by far the biggest market is the United States, by far. Over 50%, I think, of corporate debt outstanding is issued in the United States. The market is global. We are fortunate, as is Brookfield, to be part of a global firm that has visibility into what's happening. And the global forces are relevant in whichever market you're issuing in, right? China's economy is going to have an impact on the U.S. economy and so forth. So it's great to have that visibility. But I would tell you that at least the way we think about risk at Oaktree, we are really only going to stretch outside of home base if we're really provoked to do so. And right now, with base rates at 5.5%, spreads at sort of 400 for single B, where you're doing 9-10% for secured debt at very good businesses, sometimes with very good sponsors, sometimes public companies with equity behind you, it's really hard to justify reaching abroad. We can sort of get it right here.
And Cy, what about private equity? Still continuing global, or is it a similar story?
It's more of a similar story. If you think back to the credit crisis, Brookfield broadly made a lot of investments, many billions of dollars, at the bottom of the market, and we did the vast majority of it in North America, in the United States. Most liquid, biggest capital market in the world, home office to some of the greatest companies in the world. And if you don't have to go far, why wouldn't you just do it in your own backyard?
Well, and we all deploy U.S. dollar funds, meaning if you go elsewhere, you have to take currency risk.
Absolutely.
So there's just another factor if you do it.
For sure. So today it's similar story. Like, if I go back 2 years, Jared was talking about sponsored transactions that were done. And the rough numbers, if we did a screen of all the LBOs that were done and how many of them had debt yielding 15% of more, I'm going to guess we would have seen 20-ish, 2 years ago. Today there's 200. And now, they're not all great businesses, for sure. Many of them should never have been bought. But some of them are really good businesses, probably being mismanaged a little bit, over-leveraged, and those present amazing opportunities.
And he's looking for good businesses with bad balance sheets. You're trying to make sure your businesses stay good and the balance sheets are fine. But just if you took a broad section of the private equity businesses that we have,
yeah,
how are they doing?
Look, all in all, they're doing very well. Like, our same store EBITDA is actually pretty good, maybe marginally down, like ever so marginally, but by and large, they're doing well. And look, we're not immune to what's going on in the world. We have some companies that were more impacted by COVID, some that had some, I'm going to say commodity type exposure, resin prices, that sort of things, where we got hurt a little bit, but we can deal with that because we have access to capital. We've been in this game for a long time, so we always keep capital in reserve to solve a problem.
People often ask me, well, okay, if I hear Jared's story, it means there's lots of companies out there that are in trouble and they're all going to have to get refinanced. But it isn't for us, and that's because our businesses we buy are different. They're cash flow businesses, or because we put less leverage on them, or why is that the case with us?
It's because I've made so many mistakes that I've learned from over the years.
Okay, Cyrus's record is 28% IRR for over 20 years. So whatever mistakes he made are not so bad.
So no, but it's because we have access to capital, and we keep capital in reserve, right? Bad stuff's going to happen all the time. Something nasty is going to happen. I don't know what the next problem is going to be, but there will be a problem.
And Jared, I think, and maybe you could comment on this, but I think what happened was people got excited during that period of time, and they bought businesses on multiples that were high and didn't have cash flows or expected them to come. And is that what's out there? Or
I think in some sectors.
or they just went crazy and put too high leverage on it at too low interest rates?
I think it's both. I think, in some sectors, especially at that period in time, there was a drive to put risk on, right? You couldn't get you couldn't get return for investing in credit. I mean, 80% of the high yield credits outstanding at that time were going to give you less than 6%. And so the thirst for return was real, and so there was a rotation in capital into sectors like technology and other more some de novo areas around healthcare,
Growth businesses.
that were very growth oriented, pre-free cash flow, some pre-revenue.
Pre-free cash flow, that means losses.
Yeah, that's right. I guess the distress guy on stage is using the euphemisms, but that's right. And so there was a lot of, and I think something like 40% or so of the transactions that took place in that period were in two sectors, were in tech and healthcare. So you're going to see a lot of activity around those sectors.
So now I found out why Cyrus doesn't have any problems, because we
That was the
really
answer.
don't.
You
We don't have
avoided.
much tech.
Yeah.
We don't have much healthcare.
That was the answer.
Wow. And Cyrus, on what is part of it also that we built up a large operational team to run the businesses and work them out, or is it that important?
It's super important. In fact, that is our key. Look, we have two differentiators at Brookfield. One, we have hands-on operating expertise across Brookfield. We have enormous access to capital. We have a big global platform. Without that hands-on capability to improve businesses, we would not have the franchise we have today. And in fact, most of the value we have created over 25 years has come from operational improvement. That is the exact opposite of the broader industry.
Now, you did buy a software business 2 years ago, so
Yeah.
it might have fit the category of what Jared just stated. Why is it different?
Well, we are looking at mature software companies that are mission critical to their customers, large scale.
You bought it had cash flow?
We bought a business that, we're generating a 10% free cash yield day one. We sold off a division. We, enhanced the business. I think, rough numbers, our EBITDA went from something like 650 to 850 or 900. In a year and a half, we've done that on a run rate basis.
Through
All
cutting costs? Cutting costs in
Cutting
operations?
costs and selling products that are relevant to their customers and getting rid of products that are not relevant to the customers.
And it's earning today free cash flow yield of?
Oh, strong double-digit yield now. I don't know the exact number. It's probably going to get close to 15%.
And it was financed how much when you bought it?
3.5 billion equity, 5 billion
So 60%.
debt. Yeah. So, but now, if EBITDA is approaching 900-ish, well, now it's less than 4 times. So that's what we want to do in software.
And Jared, if and maybe just many people in the room were around in 08 and 20. Many people weren't in some of the prior meltdowns, but just if you take 08 and 20 and compare it to now, what would you, like, how would you?
Just to mention those two?
Just for people, because many people here probably lived through both.
Sure.
And right now, is it similar or different? And then what do you predict over the next 18 months?
So sticking with what is easier to talk about objectively, when the global financial crisis set in 2008, as I said earlier, it was really initially narrowly focused on a set of actors within sort of the financial institutions. Obviously, there was contagion across the whole market, but the epicenter was very clear. The amount of liquid distress opportunity set that resulted or came as a result of the financial crisis was very profound, and it was relatively relative to 2020, it was longer lasting. It wasn't long lasting because there was an intervention from central banks, and there were some government rescues that took place, but there was a multi-quarter window where folks like ourselves were able to, if you had the stomach to, step into the breach and buy distressed liquid credits in high quantities, high volumes at very low dollar prices. And we, just to speak about Oaktree, in that period, in the 12 months from, take July of 2008, 12 months forward into June of 2009, we invested more than we had ever invested in our firm's history to that point, over $10 billion.
In that period, you were putting, that sounds like almost $1 billion a month?
Something like that.
Wow.
And at the peak, probably higher. So that is
Right.
maybe the belly of that was probably in the fourth quarter of 2008. I think we put $5 billion to work in that quarter. In 2020, the correction and then reversal was much sharper. So there was really less than a month, maybe it was 3 weeks, where there was real dislocation in liquid public credits. And so you had to be ready, and you had to be big in terms of not just capital, but also people to have buy targets out on enough different issuers that you could get access to the very limited amount of liquidity.
And have enough information on them. Right.
And again, the stomach, I would say. So we were very active participants in both. We actually, in spite of what I just said, we invested more money in the 12-month period around the pandemic, about $14 billion as a firm. And the reason is, in that instance, we were focusing not only on the public distress, but also on private capital solutions. So we were not just sort of taking advantage of distress in the liquid secondary market. We were proactively helping companies.
And just for the benefit of everyone, like you financed LATAM Airlines, I think.
We did.
If I recall.
We did.
With a big rescue financing, which clearly you said you have to have stomach. Clearly financing an airline in April of 2020 when there wasn't a plane flying you had to have a lot of stomach.
You did, although when we tell the story now, it seems sort of obvious.
I realize
right?
that. It never feels like it at the time.
You know, the number one market share flying around Latin America, could you close your eyes and envision a world where you were never going to see LATAM Airlines board a plane again? I think we were fortunate enough to be able to see a future where this was a good company that had a temporal issue.
And okay, so I got that on the past, but what about, what does that mean for right now? How does that compare to what people are interested here is not the past? What does that infer? What do you infer from that information and take the environment we're sitting in right now? What does it mean for the next 18 months?
A few things. And I work for someone in Howard Marks that is fortunately very reticent to make economic forecasts, which gives us the license to admit that we actually have no idea what the next 18 months or further, let alone, are going to bring. But what seems to be the case is that we are in a higher for longer market. As recently as yesterday's Fed announcement, it seems like the yield curve is starting to flatten. People are less convinced that there is going to be a rapid decline in interest rates.
And when you say higher for longer, what you mean is higher in this range for longer, not higher.
That's right. That's what I meant.
This range of interest rates
We're
for
in
a longer
normal
period of time.
Yes,
okay.
thank you.
Got it.
And so as a result of that, a few things we think are likely to be the case. One, as we talked about earlier, companies that don't have the access to capital or haven't grown into double-digit free cash flows, as Cyrus's company was describing, are going to have a hard time refinancing their debt. It doesn't really matter whether we have a hard landing or a soft landing, whether we're an accelerating economy or not. There is going to be a wave of maturities.
They have too much debt at these interest rates, therefore they're going to have a problem.
Period, full stop.
But it sounds like it's not, like in 2008, it went like this. And in 20, it went like this. It sounds like this is a march to 28 billion put to work. It's not a...
That's what we're sort of bracing for. But what tends to happen, and I would have...
You're bracing for just a pace of deployment.
Yes, exactly. Lots of rescue loans, lots of private capital solutions, the occasional default and bankruptcy, where maybe there's a dip or a rescue loan or something that we can do to help a company restructure. But it is certainly possible, and I think, I hesitate to say probable, but what ordinarily has happened is there's a catalyst, maybe one that we haven't predicted or that isn't obvious, that swings the pendulum
Something
way to the
happens
other
in the
side.
world.
And if you go back 12 months and looked at where public markets were pricing risk, 12 months ago, I think most people would have said we're in for a hard landing. Credit spreads were touching 600 basis points over base rates. The equity markets were down. I think the equity markets finished last year down 18% or so. S&P, I think, was down 18%. High yield was down 11%. Right now, 1 year later, I'm not sure all that much has actually changed. The Fed did exactly what they said they were going to do. The economy is not rapidly accelerating. We may not be in a recession, but we're not rapidly accelerating. But the sentiment in the market is for sure soft landing. Goldman has reduced their recession predictor. So, and what's happened? Credit spreads are now 400. So they've come in 200 basis points.
Cy, do you have a view?
I think he said it much better than I can ever say.
But you don't think there's, other than something, there could be accidents out there. There's just going to be opportunities coming along.
Lots of opportunities coming, and I think for our private equity business, the most important thing is we're in a reasonably stable rate environment as it relates to long-term rates, and we finance most of our businesses based on long-term rates.
And what gets you most excited, other than everything, now?
What Jared said, technology and healthcare, is very relevant because that's where all the capital flowed into. That's where the biggest debt problems are, and that's where we're spending a lot of time today.
Which is why 18 months ago you started building businesses in both of those, but deployed very little money.
Correct.
And is it buying secondaries, or it's just it's all the above?
All of the above, but the bottom line is there are going to be great businesses that can't be refinanced and they need help.
Jared?
I think for us, it's just the numbers. We have a 100-year history of 9 to 10% returns on stocks, and right now that's what you can achieve buying secured debt that's performing, let alone finding the opportunistic opportunities.
Although
in credit.
you earn 20% returns in your fund, not 9 or 10. You're saying 9 or 10 in performing credit. Can you buy performing credit or earn 20?
You can wake up and invest in performing credit, even factoring in a point or two of losses, and essentially match the 100-year return on the S&P right now. And hopefully with some underwriting skill and what we've been able to do historically in our strategy, that's the starting point. And so we should far exceed that.
So before we end, I'd sum up by saying, thanks both of you for being here. We think the world is, there's a lot of opportunity that's out there, and it's going to be very interesting for both of these businesses, but merely because we have access to capital and a franchise that can capitalize on it. And I'd say that's probably what sums up our views in general. So thank you for listening. We need 1 minute to adjust these chairs, and then I think Cyrus is coming back up to start the discussion on Brookfield Business Partners.